every once in a while, it's interesting to see what the average retail investor is thinking and doing. That would be you and me, the retail investor, a fancy term for us, those of us who buy stuff. While there are many surveys done on investor sentiment, there are relatively few on what the average investor is actually doing. So in this morning's U.S. Bank Economic 360, we take a peek at the tracks retail investors are leaving in the snow with Jim Russell, U.S. Bank's senior equity strategist. Good to see you, Jim.
Good morning.
We're coming out of a period where the average investor has sort of run away from risk. What does that mean to the markets? How does that work with the markets?
Yeah, great question. So, we have come out of a period where the average investor has been risk averse, risk intolerant, and running away from risk a little bit. The financial crisis, Brian, really put at risk governments, countries, individuals, consumers, a variety of ancillary impacts. So when risks rise, you can see that in the upper left-hand corner there, normally investors flow out of stocks into really two lower volatility categories, cash and bonds. Now, of course, what we're seeing more recently is that actually risks have actually decreased to a degree. And so what we see in that particular type of transition is a flow from cash and bonds back into stocks. And in fact, we're starting to see evidence of that kind of flow taking place at the retail level.
I like the way you call this tracks in the snow. How is this investor activity actually measured, Jim?
Well, as you'd mentioned, Brian, there are all kinds of surveys that actually ask investors, what do you plan to do? Well, there are just a couple of surveys out there that actually track what investors actually do. And that is, are they buying stocks? Are they buying bonds? Are they doing other things? And so what we've done here is put together a graph that shows for mutual funds over the last, call it since 2008, so the last several years, what have investors actually done? You can see the red line on top where investors have actually bought a tremendous amount of bonds until just recently, and you see the inflection point in 2003. You can see that starting to tip over a little bit. Same thing for stocks, but almost opposite. And that is, since 2008, investors have flowed out of or sold stocks in the mutual fund complex, and actually until 2003, and we're starting to see a hook up. So actually, investors these days are starting to run back toward the stock market, maybe toward taking a little bit more risk as things stabilize.
But that's a pretty dramatic shift. What would you say is behind that?
Well, there are several things. Number one, we're starting to see clear evidence, and we got GDP numbers just last week, where the United States grew in 2013 at 2.7%, and we're looking for something in the 3% range for 2014. So it does appear that housing has stabilized a bit. It does appear that all kinds of economic metrics, employment, certainly in the markets have stabilized a bit. And growth both in the United States and in Europe have stabilized a bit. So those factors combined together, frankly, take investors and perhaps ask them to maybe return to a more active and slightly higher risk profile of stocks. Improving economic data. Also, the Fed does enter into that, is that they're going to be increasing interest rates probably in the 2015 period. Higher interest rates means lower bond prices. So again, investors from cash and bonds into stocks.
Interesting look at the tracks in the snow. Thank you, Jim.
Yes, sir.
We appreciate you and
Thank
U.S.
you.
Bank.